Good morning, everyone. This is Patrick Kappel coming to you live. Vanessa isn't going to be able to make it on today. That's okay, though. We're going to be covering taxes and real estate taxation specifically, as we promised last week. Now, last week, we discussed some real basic real estate investment financials. We went over things like what's a cap rate? What's a gross rent multiplier? How do you calculate net operating income? And then we went into the MLS and we looked at 2 to 4 units that are on the market that are being sold and how they are being marketed incorrectly. They had bad calculations, or they had blanks in the calculations. So today we're going to build off of what we learned last week. We're going to talk a little bit more about cap rate and those basic financial calculations, but now we're going to apply them to looking at the tax code and how can the tax code help us with investment real estate. I see there's still a lot of people that are joining and signing on. So I'm going to switch over to my shared screen mode and start diving into some numbers and some graphics that I can share with all of you. So hopefully you can all see what I'm looking at right now. Again, today we're going to talk about taxation and specifically real estate taxation. How does it affect you? How does it affect your clients? Last week when we discussed cap rate, I kept on saying higher cap rate is better, higher cap rate is better. Today, I'm going to show you some situations where maybe not. I wanted to make that blanket statement of a higher cap rate is better last week because I didn't want to get too complex diving into taxes, diving into appreciation. But today we're really going to go a little bit deeper into why maybe a low cap rate and a high appreciation rate is better. So what I'm going to teach you today is useful for you as a real estate professional, but also for your clients. Every time I teach finance and specifically real estate finance to realtors, I have 2 goals in mind. One is for you to be able to teach your clients and you to be able to help your clients. You and I both know that most realtors out there are not educating their clients very in an in-depth way when it comes to taxes, when it comes to finances. So if you can teach your clients, you will get more clients, and then in turn, you will make more money. So goal number 1, teach you to teach your clients. Goal number 2 is every realtor out there in the long term should also be investing in real estate. I was on the Lab Coats Facebook page the other day, and I saw a relatively new realtor ask, what should I be doing for my retirement plan? And 90% of the answers were invest in real estate. Even I hopped on that one. And I just put in 2 words, real estate. If you're a realtor, one of your number 1 goals should be retiring through your real estate investments. Most successful, not most, all successful realtors I know out there are also investing in real estate. One of my mentors told me, if you're a realtor, you should be trying to buy, once you get to the ability to, try and buy at least 1 property a year. So that's something I adhere to. So what I'll be teaching you today is also going to help you with your own personal wealth growth and your own personal real estate analysis. How should you invest? How should you not? You can see I've got 5 topics up here: taxation and your residence, depreciation, cost segregation studies, 1031 exchanges, and a step-up cost basis. Of these 5, we're not going to hit all of them today. Things like a 1031 exchange, cost segregation study, those are webinars on their own, which I could spend 60 minutes on. So what we will cover today, and for specific reasons, 1, we'll cover taxation and your residence. Why? Because this is information you can and you should share with your clients. And then the second thing I'm going to cover today is taxation of investment real estate, how your cap rate is taxed different than your appreciation rate. And this is important to know no matter what market you live in, But especially if you live in a market like mine, where investors in San Diego, where I live, they make their money off appreciation, not so much the cash flow. And I'll show you by the end of today why that is actually more advantageous and a better tax play. But first, let's dive into taxation and your residence. Now, the tax code was changed under the Donald Trump administration. And one thing I want to add too is it might get changed again if Biden ends up winning this fall. So tax codes are always changing. As a realtor, we're never going to know as much as a CPA when it comes to the tax code. So I always advise my clients, and I advise you, have a good CPA that you work with. If there's one thing you take away from this, have a good CPA. Certified public accountants, they charge less than you might think. I have a really good CPA that does my personal taxes, my trust, and a couple of businesses I own. And I think I pay maybe at most a couple $1,000s a year for really good advice, 12 months a year. So get a good CPA. But as realtors, we're always told as realtors, we shouldn't give tax advice. We shouldn't give finance advice. We shouldn't give any advice as realtors is what we're told. In my opinion, because of liability, right? Because of liability. In my opinion, if you're a realtor and you can't give any advice, and if you can't give a little bit of advice about taxes and how it relates to real estate and finances and how it relates to real estate, then you are not being the best realtor you can be. Our job is to be advisors to our clients. And someone might play devil's advocate and say, yeah, Patrick, but what if you give tax advice and you get sued? You give tax advice, it's wrong, and you get in trouble. That's why you always finish every single conversation about taxes with the client by saying, but run it by your CPA. This is what I think about taxes, but run it by your CPA, okay? But you ought to add that extra level of value to your client that most realtors don't, and that will make you stand out as a star realtor in your city. So on that, let's talk about taxation in your home and what you should be sharing with your client. Under the old tax law, you used to be able to write off all the interest payments associated with your loan up to $1 million and up to $100,000 in a home equity line of credit. You can no longer do that. It's now capped out, and this happened a few years ago with the new tax code. It's now capped out. It's $750,000. So if you're helping a client and they go out there and they buy a new residence, one that they own or occupied, and they get a $600,000 loan, they're fine. They can write off every single penny of interest that they make towards that loan payment throughout the year. If they get a $750,000 loan, they're fine. They can still write off every penny of interest that they make towards that loan throughout the year as a tax write-off. Now, obviously, if they get an $800,000 loan, they can only write off $750,000 of the loan. The other $50,000 of the loan, they cannot write that off. So how do you calculate that? Well, $50,000 they can't write off. $800,000 loan. What's 50,000 of 800,000? 1/16. So approximately 1/16 of the loan, the interest associated with it, they can't write that off. And you can probably already start to see why it's important for you and for your clients, your new homeowners, to have a good CPA to assist them with these calculations. The $100,000 home equity line of credit, that is no longer deductible. So if you take a $100,000 home equity loan, you can't deduct the interest associated with that loan unless you do something called interest tracing, okay? So what is interest tracing? Interest tracing is like, well, maybe you take a $50,000 home equity line of credit out and you use it to invest. And you use it to invest as a down payment on a new duplex that you go out and buy. Now you might be able to write off the interest associated with that portion of that loan because you used it for investment purposes. If you're going to cross that line and start going into interest tracing, the definition is pretty much tracing the loan that you took out and the uses of that loan. Tracing the interest, tracing the uses of it. If you're going to start to go down that route, you definitely want a CPA assisting you with your taxes. The other big thing that changed with the tax law a few years ago is 10,000 cap on SALT taxes. So what are SALT taxes? SALT are state and local taxes. So as we all know, we pay real estate taxes. If you buy a property, you probably pay real estate taxes. Down here in San Diego, it's about 1.25% of assessed value paid in real estate taxes every year. We used to be able to write off every single penny of taxes that we paid in real estate taxes against our federal tax return. So if I paid $15,000 in real estate taxes this year, I could write off $15,000 worth of those taxes on my federal tax return. Now, with the new tax law, and I say new, it's now a few years old, let's be honest with ourselves, but it's still relatively new compared to the old tax law we had for quite some time. But now, if I have a $15,000 real estate tax payment that I make this year, I can only put $10,000 of it towards a write-off on my federal tax return. And I can't write off that other $5,000. And when I say state and local taxes, it's not just real estate taxes capped at $10,000. It's also the state income taxes I pay. So what do I mean by that? If I pay $15,000, or excuse me, if I pay $10,000 to the state of California as an income tax payment, now I'm already capped out on the amount of state and local taxes that I can write off on my federal return, which means my real estate taxes, I can't write off on my federal return at all. I can still write it off on my tax return, but not my federal. There's a lot of stuff I'm tossing at you in just a few minutes and on one slide. So all of these items, if it's not clicking, if it's not making sense, ask questions in the question bar and I'll answer questions as we go in towards the end. But also just Google these things, guys. I don't want to say Google is the #1 primary source in the world, but it can teach you a lot. You can find a lot of articles written by CPAs, written by accounting firms about your mortgage interest deduction limits, about SALT tax limitations, and about interest tracing. So if these things aren't clicking 100%, research them, dive more into them. But this is some very basic stuff that as a realtor, you should be able to speak with your client about, especially the interest deduction portion and the fact it's capped now at $750,000. The other thing that you should definitely know about and be able to intelligently discuss with clients, especially sellers, is what happens when you sell your property. What if you buy something for, I don't know, $400,000 and you're going to sell it years and years later for $900,000? You just made $500,000. Do you have to pay taxes on the gain at a sale? Or what if you bought something for $400,000 and now you're selling it for $500,000? Do you have to pay taxes on that $100,000 gain? Well, the tax code has the answer to everything, and it has the answer to that. If it's a primary residence that you're selling, i.e., you've lived in it, and the IRS definition for this, for the purpose of tax-free gains, is have you lived in the home that you sold 2 out of the last 5 years. It doesn't have to be the last 2 years. It just has to be 2 out of the last 5 years. So if I lived in this home up until like 2000 to 2018, and I moved out in 2018, I haven't lived in there the last 2 years. And if I sell it this year, I can still by definition say I've lived in it 2 of the last 5 years. So it could have been 2 or 3 years since you lived in the home. But if you've lived in it 2 of the last 5 years, you get to write off, or not write off, but take as a gain $500,000 in profit and not pay any taxes on it if you're married. If you're single, you can take up to a $250,000 profit, as you see on the left, and not pay a penny in taxes. So your home, it's been said, and I think even Robert Kiyosaki and Rich Dad Poor Dad said that a home is a liability, not an asset. That's one point where I would disagree with him. Your home, if you buy a home that's going to grow in value, not shrink in value, is an asset. Does it cost you money every month? Absolutely. Of course it does. But if you're not living in a home, you've got two other options. You can go live in a box, or you can go rent an apartment. An apartment's going to cost you money as well. So an apartment, one could say, is a liability. Now, the only difference between that apartment and a house is going to grow well for you, an apartment's not. So do not be misdirected. A house is not a liability. It is an asset. 100% a house is an asset. Your mortgage is a liability, but your house is an asset. And you can talk to any CPA and they will tell you the exact same thing. They would say, yeah, you've got a balance sheet. And on that balance sheet, you got assets and liabilities. Your house is an asset. Your mortgage payment is a liability. Okay. Now, if you're renting, you don't have any asset. You just have the liability. And that is your mortgage payment. So to all of my clients who say, well, isn't a house a liability? I say, no, a house is an asset. Mortgage is a liability. A property you rent is not an asset, but the rent is still a liability. You need to have that asset on your balance sheet. So it makes just quantum leaps more sense to own instead of rent. But this portion of the tax code, guys, is one of the biggest reasons. I don't know any other investment, not even retirement accounts, where you can make up to $500,000 in a gain and walk away without paying any taxes on it. I've got a client right now, married couple. They bought a house for around 1.3 and they're selling the home for 1.65. So they're making about $250,000. They've owned the home for a number of years. And of the $250,000 that they're about to make, they don't have to pay any taxes on that gain. Now it mentions up here reduced exclusion. That's if you get to the point where you haven't lived in it 2 of the last 5 years. Maybe you've lived in it only 1 of the last 5 years or 18 months of the last 5 years. There's also an issue if you've written a portion of your home off as a home office, you're also going to, you'll still be able to make a lot of tax-free money, but there's going to be a portion that might not be tax-free because you've done all those write-offs. Rental property doesn't count for this exclusion. For rental property, investment property that you haven't lived in, you get to do something called a 1031 exchange, where you can buy more property and defer your tax payment, but you cannot completely avoid the tax payment. So bottom line, folks, your home buyers, all the equity they make in that home, if they're married up to $500,000, all that equity is tax-free, and they can sell it and pocket that money tax-free. Now I'm going to skip out of the slide for a second and go to an Excel spreadsheet. You guys know that I love Excel spreadsheets. So I'll take a quick look, see what questions we got. Does it have to be continuous 2 years? Oh, that's a great question. So one of the questions we got is, do you have to live in the property for a continuous 2 years, or can it be 1 and then a break and then 1? It doesn't have to be continuous. When I say 2 of the last 5 years, take that statement at face value. Can you add up 24 months? Have you lived there for 24 months in the last 5 years? And it can be you lived there for a year, and then you didn't live there for 3 years, and then you lived there again for a year. That's 2 of the last 5 years. So Linda, to answer your question, yeah, it doesn't have to be a solid straight 24 months in a row. It's 2 of the last 4 years. And guys, I'm telling you, there is no retirement account I've seen in my life, no IRA, no 401k, not even a government pension or Social Security or disability check that has such good tax benefits, because here you are getting a windfall of potentially tens, if not hundreds of thousands of dollars on the sale of your home, all tax-free. So before I move into more of the investment side and the cap rate, I want to talk more about our clients and just home ownership for our clients. I have a client that was renting for around $3,000 a month. In fact, they were personal friends of mine. I've been to their wedding. They came to my wedding, known them for a decade or so. And they've been renting for $3,000 per month in rent. they came to me one day and said, you know what, we're ready to buy a house. And I said, all right, let's start looking around. And they were qualified up into well into the 1 millions. And we were looking at like 1.1, 1.2. Nothing was really doing it for them. And then they found this house at 1.35 million. 1.35 million. That might sound like a lot of money, and it is. That's a lot of money even in San Diego. Fortunately, my friends, they work in the medical field and they have really good jobs. The 1.35 million price tag was kind of eye-opening and jaw-dropping for them. But what was really eye-opening and jaw-dropping for them was their new monthly mortgage payment, which now is going to be over $6,700 a month. So when I showed up on closing day, I knew they were nervous about this new payment. So when I showed up on closing day, I didn't show up with like a bottle of champagne and a bouquet of flowers. I showed up with an Excel spreadsheet showing them the real cost of home ownership. And what I'm about to show you is exactly what I showed up on the doorstep with when I handed them their keys. This Excel spreadsheet printed out because I knew a bottle of champagne might ease their nerves. A bouquet of flowers, common closing gifts might make them feel good. A gift card to a restaurant might fill their stomachs. But an Excel spreadsheet showing them the true cost of home ownership will calm their nerves and make them feel good about their purchase. And at that point in time, that's what they needed. And I needed to show them that their mortgage of $6,752, that's a lot to pay each month. I need to show them that $6,700 is a smaller cost of living than $3,000. I needed to show them that. And you might be asking, how is $6,700 less money than $3,000? I didn't say it was less money. I said it was a lower cost of living than $3,000. By paying a $6,700 mortgage, they're paying less to live than if they were paying a $3,000 mortgage. So let's break down the math and go through the numbers. And you guys kind of follow this, because if you can give this to your clients will love you forever. So this house, purchase price, top left, 1.35 million. The loan on it was 1.197. And you might be thinking, again, those are big numbers, and they are. If you're in a different market, heck, you could just take off the last zero. Maybe you're in a market where the purchase price is $135,000 and the mortgage is $119,000. Just take off the last zero. Move the decimal one to the left. On all of these numbers, take off the last zero. And that could be a market like where I grew up, North Dakota. And the rent probably wouldn't have been $3,000. Maybe it would have been like $600 a month. But you're going to come to the same conclusions no matter the market you're in. Because I'm telling you, every market, ownership is better than renting. So let's break down this mortgage. Let's break down this $1.1 million mortgage into the interest payment. Monthly was $3,740, so $3,740. The principal payment, $1,802. The taxes, $1,140, and the insurance, $70 a month. In this next column, column C, you can see that I just took everything times 12, everything times 12. And that is going to give us the annualized interest payment, annualized principal, annualized taxes, annualized insurance. So every month they're paying $67.52 to live in this place, and every year they're paying $81,000. Not a small amount of money. Now let's start looking at the true cost of home ownership. A portion of this mortgage interest is deductible. What portion? You guys know the answer. I just covered it like 10 minutes ago. We can deduct the interest associated with $750,000 of that loan. That's tax code, right? So I did the calculation, and $750,000 of this loan happens to be 62.6% of that loan. So I simply took 62.6% times their annual interest payment, and they can deduct $28,095 per year off of their taxes. Now, very important. This is if you have a client that itemizes their taxes. If you have a client that just does a standard deduction, then they might not be itemizing. And if they're not itemizing, they won't be itemizing these interest expenses against their federal taxes. So I always like to make that disclosure to all clients and all realtors. This interest deduction is if you itemize, not if you're taking the standard deduction. If you don't know the difference between those two, Google it, research it, talk to a CPA, standard deduction versus itemization. Now, any client who's buying in the $1 million range, chances are they are itemizing their taxes because they are probably doing a lot of different tax write-offs, a lot of deductions each year. So as I mentioned in the spreadsheet I gave to my client, only $750K is deductible. So here we go. They've got a $28,000 tax deduction. Now for this client, assuming that they're in the 24% tax bracket and the 9.3% California tax bracket, then their top income is being taxed at the 33.3% tax rate. So for this client, it absolutely is making sense for them to not take the standard, but to do this and to itemize. So they are now not paying taxes on a little over $28,000 of income. If they're not paying taxes on over $28,000 of income and their tax rate is 33.3%, that gives them an annual tax savings of $9,355, which divided by 12 equates to $780 a month in tax savings. So this, very importantly, directly affects their cash flow because your tax payments are cash flows out. Every time you pay Uncle Sam, that's a negative cash flow. That's cash flow going to Uncle Sam. So they are now not paying Uncle Sam $780 a month. That's not coming out of their paychecks. That's not coming out of their tax deductions. They're not paying that $780 a month. So that's a cash flow going out that doesn't exist anymore. So that 780 we can build right back into their financial analysis right away. Let's go back over to the left though. Before we build that back into their payment, let's go back to the left and let's talk about appreciation for a minute. Now, some people can say that appreciation is speculative. And I would say, well, if appreciation is speculative, then so is the sun setting, so is the sun rising. And so is me waking up in the morning and not dying of a heart attack in my sleep. I'm speculating I'm going to live through the night because I might not. And you might say, yeah, but the sun coming up, the sun going down, and you waking up in the morning has a higher chance of certainty than appreciation. And with that, I would disagree. And I would remind whoever it was I was discussing with that appreciation, unless you buy in a ghost town, unless you buy in a town that has a shrinking population. And if you do that, you should be doing that anyway. And if you've listened to my webinars enough, you know that when I buy, I look at the economy of the city, the economy of the town. I don't look so much at the property I'm buying. I look at the economy around the property I'm buying to ensure we have continued growth, to ensure it's diverse. I don't buy in economies like Detroit that is heavily reliant on one industry, the auto industry. I buy in diverse economies. If you look at every diverse economy around the United States, you will see that appreciation has happened continuously year after year, decade after decade. Now, are there some years where we've gone down? Sure. 2009, 10, 11, 12, we slid a lot in San Diego, but you will not find a 10-year period where property values are worth less than they were 10 years ago. You just simply won't. And even in the worst of cities like Detroit and all these places becoming ghost town, I can guarantee you property is worth more there now than it was 50 years ago, than it was 100 years ago, simply due to inflation. But your job is to hopefully buy property that's going to outpace inflation. Now in San Diego, for the last 50 years, we have appreciated at about 4.72%. I often say 4.5%. To be conservative, I round it down to 4.5. In this case model, to be ultra conservative, I rounded it down to 4%. Now, if I have 50 years of data showing me that San Diego has appreciated over 4.5% for the last 50 years, saying that we're going to continue to appreciate at 4% is a pretty reliable figure to use. I would argue that I think we're going to appreciate even faster than 4.5% due to a multitude of economic things happening right now in San Diego and a shortage of housing. We probably will appreciate more than 4.5%. But again, I want to be conservative. So I just put in 4. If you want to be ultra conservative, then just put in inflation. The rate of the federal government's appreciation, which right now is around 1, at the highest 2%. That's if you want to be ultra conservative. But in this case model, we used 4. Use what you want for your market. You know your market better than I do. And at 4% appreciation, a $1.35 million home is going to appreciate $54,000 a year. And you might say, my God, that's a lot of money. And you're right, that is a lot of money. But 1.35 million is a lot of money too. 4% of that, $54,000 a year of appreciation, or $4,500 a month. So that home that my friend just bought is appreciating at $4,500 every month that they live there. So now we look at the real cost of home ownership. Before I get off of that too, again, you might say, Patrick, that's bogus, that's crazy. There's no home that appreciates at $4,500 a month. And again, I would beg to differ, and I would tell you the home I live in right now is appreciated $4,500 a month for the last 8 years, ever since I bought it. There are markets out there, folks, where homes appreciate thousands of dollars every single month. They're not the cheap markets, though. They're the markets like San Diego and other higher end markets. Seattle, we got a lot of investors that invest in Seattle. So now let's look at the real cost of home ownership. We see their mortgage payment is big, $6,752, $6,752. That's a huge mortgage payment, folks. But let's talk about their principal payment. We haven't even talked about principal payment yet. You and I know that a mortgage is made up of principal and interest. And then you tack on taxes and insurance, PITI, pity. And your principal payment is not, it's not a cash outflow off of your balance sheet. Is that principal payment in your check that you write every single month? Absolutely. Does it leave your checking account? Absolutely. But does it leave your net worth account? Not at all. Does it leave your balance sheet? Not at all. It's a transfer of money from cash to equity. Cash to equity. It is not leaving your balance sheet, i.e. your personal net worth is not going to change because of that $1,802 going towards principal. It's just going to be transferred from your cash to the principal, the equity, the net worth in your house. So you need to build back in that principal payment when you're calculating the true cost of living in a property versus renting. 2, we need to bake in that tax savings. That tax savings we calculated up here on the right is $780 a month. Now that truly is a cash inflow, or it's not a cash outflow. You are not writing Uncle Sam that check for $780 a month. It's not coming out of your paycheck. You're seeing your checking account grow by $780 more a month due to not paying that tax that you wouldn't have if you were renting. So we need to bake that $780 back in. So now our real outflow of net worth, or as I wrote here, your real cash outflow, but your real outflow of net worth is $4,170. That's if there is no appreciation. If there is zero appreciation, you're really paying $4,170 to live in that house. More than $3,000, no doubt. But you and I know that over the next 10, 20, 30, my clients told me this is their forever home. They're in their 30s. So they're probably going to live here for 50 years. You and I know that over 20, 30, 40, 50 years, they will hit the long-term average. They'll have some years where it goes down, some years where it goes up exponentially. But in the long run, they will hit the long-term average of appreciation. I put in 4%. I honestly think it's going to be more like 4.5%, 5%, but they will certainly hit 4% appreciation. And that equates to $4,500 a month in appreciation. So their real cost of $4,170 minus the appreciation that they're seeing in the house every year gives us a negative $330 a month. What does that mean if it's negative? That means they're getting paid to live in their house. They're living there for free and they're making $330 a month. So let me step back a second. You might be like, Patrick, they're not getting paid. Nobody's writing them a check for $330. And you're right. Nobody's writing them a check for $330. They're not getting paid in the conventional sense of getting paid $330 to live in the house, but they're getting paid in this sense. Their net worth, if they rented for $3,000 a month, their net worth is going down $3,000 a month. If they're renting, they're losing that $3,000 a month. It's a hit against their net worth. If they own, their net worth, not only is it not going down $3,000 a month, their net worth is not going down $6,752 a month, even though they write a check for $6,752 every month. Their net worth isn't going down that amount every month. Their net worth is going up $300 every month because of the principal payment, the tax savings, and the appreciation. And by owning, they are living in this house for free, and their net worth is going up $330 a month. You can track this type of thing on personal capital. That's the thing I use to track net worth. And you guys might think, Patrick, this sounds crazy. These are lies. They're really writing a check for $67.52. I don't understand that whole $330 thing. If you don't understand it, guys, I'll teach another class that dives even deeper into this. And I have done this myself. The house I live in right now, guys, I write a check for probably $7,000 or $8,000 every month to live in this house because I've done a lot of cash out refis, interest tracing, all kinds of crazy stuff. But I write pretty big checks to live in this house. But I live in this house for free. What do I mean by that? The house I'm sitting in today, I live in for free because when I look at my tax deduction savings, when I look at my principal buy down on my house, and when I look at my appreciation rates of my house, year over year, month over month, it is always a greater gain than what my mortgage check is every month, than what I write a check for the mortgages every month. And in fact, the gain is so great, I've done cash out refis on my house. I calculated, and I've looked at the math going backwards the last 8 years I've lived here. And I've been able to gain so much that I've been able to pull more cash out of my house than what I've paid into it in mortgage payments. So yes, guys, it is truly cheaper to own than it is to rent. Ownership can be free in the right market. You can live for free. We just helped a client of ours 2 weeks ago buy a fourplex. Young guy, first property he bought in his life, $1.2 million fourplex. You might be saying, how does someone buy their first property as a $1.2 million fourplex? How do you qualify at 1.2 as your first property? Easy. The rents off of the 3 units he's not living in count towards his income. And then he lives in unit number 4. The rents off the 3 units he's not living in pay for 100% of his mortgage. Pay 100% of his mortgage, and he's still making $600 on top. So that's another story all in itself. The kid even made a YouTube video about it. But buying a multifamily is one way, but I just showed you in a spreadsheet how a client can go out and buy a $1.35 million property and get paid $300 to live there. Now, my clients are no dummies. My clients that bought this home, they both have master's degrees. They both work in the medical field. And I showed them this spreadsheet, and I talked through it the same way I just talked with you. Their jaws hit the floor again, and they said, oh my God, this makes us feel so much better. We now realize that this is cheaper than renting. And the husband of the two wants to invest in real estate. He's always wanted to invest in real estate, and this just made him even more eager to get into real estate investment. Now, I see that there's a ton of questions. There's a lot of other stuff I can dive into, and I will. But I first want to read through some of these questions to make sure I address your questions during these last 20 minutes. Can we have access to this webinar? I feel like I keep missing little bits here and there. Yes, guys, I know I might sometimes talk kind of fast. I try to talk slow, and from my understanding, these webinars are all I know they're recorded because I see a record button, and they are posted on the Lab Coats Facebook site. If they're not, Jake, I know you're moderating this. Please let us know if they're posted, how people can access it.
You can check it out at our YouTube Lab Coat Agents page and also Facebook Lab Coat Agents.
Awesome. And maybe if you could type those links in the YouTube one into chat, and you folks, yeah, watch these, rewatch it. It's recorded, watch it a million times. And I try to overlap these Thursday webinars, and sometimes I will go back. You might see me 2 or 3 months from now do this exact same thing and go back to it, because I've learned you need to do something 3, 4, 5 times before you really understand it. Does your spouse need to be on the title to claim for the tax exception? And that was asked by Aurora, I believe. That's a great question, and that's a good question for a CPA. I don't want to give a direct answer to that question because I don't know it. And if there's something I don't know, I will admit it. I think I'll find out. I'm going to ask my CPA that question maybe later on today. I would think, I don't know. I don't even want to tell you what I think. Well, what I think is maybe no, because your spouse is on it. And especially if you're in a community property state like California, my income is my wife's income and her income is my income, right? Community property. So I don't know, but you need to ask a CPA that question. And another reason is every state's different. You might live in a community property state, and another person might not live in a community property state. So just as you all have already learned, real estate is state specific. Taxes can somewhat be state specific too. Now, federal taxes are national, but state tax is state specific. So ask a CPA in your state that question on if your spouse needs to be on title. Now, one person says, if I sell after 3 years, can I take the 250 or 5? Okay, yes, I think you can. I'm pretty sure you can, because you have to have lived there 2 of the last 5 years. And if you live there 3, I would say, yeah, you've lived there 2 of the last 5 years. But again, another one to ask your CPA. Guys, I like to say I know enough about taxes to be dangerous. I know enough taxes to challenge my CPA. I challenge him and I ask him the hard questions. And sometimes I'll ask my CPA a question and he doesn't know the answer and he has to go talk to some of his associates and his partners in his firm. So know enough to be dangerous, know enough to challenge and ask those hard questions. But when we get down in the nitty gritty, like I've lived there for 2 years and 6 months, do I still get the full exception? My answer is yes, I think so, but let's double check with a CPA. Because I'm not a CPA and I know a lot about taxes, guys. I was a teaching assistant in grad school at UCLA for a tax course to grad students, because I did really well my first year in the tax course. So I got to teach it the second year. But I still don't know half as much as a CPA. That's why, although I know taxes, I hire a CPA, I pay a CPA. And one time my CPA said, Patrick, why do you hire me to do your taxes? Why don't you just do it yourself? And I said, because I don't know as much as you. I know a lot, but not as much as you. And I don't know the latest and greatest in the tax law because I study real estate day in, day out, but I don't study taxes day in, day out. So take that one to an accountant as well. Okay, closing gift. Yeah, guys, closing gift. My gift to my clients is always knowledge. I give away, let me be honest, I gave them $100 gift card or something to a restaurant. So I did give them a gift card to a restaurant just because why not? But I also gave them that Excel spreadsheet. And if you can make your client feel 2 things, you want your clients to feel 2 things. You want them to feel at ease. You want every client to feel at ease, be it a buyer or be it a seller. And if you don't know what you're talking about as a realtor, they will never feel at ease. They're going to feel very, very nervous. It's kind of like if I go on an African safari and we're looking at lions, tigers, and bears, and my safari guide seems nervous, it doesn't seem like he knows which way the trail goes, I'm going to be nervous about the lions, tigers, and bears around us. But if my safari guy acts like this jungle is his own backyard, I'm going to be completely calm. And real estate's a jungle. You need to act like it's your own backyard. You need to know it inside out. Put your clients at ease. So that's the first thing you need to give them. Give them the feeling of comfort and ease. The second thing you need to give them is the best agent they can ever talk to. You need to be knowledgeable about this stuff. Don't spend 90% of your time, marketing the flashy side of real estate. Spend 90% of your time understanding and learning what some might consider the boring side of real estate, but I think is exciting, and that's the finances, the taxes, etc. Can I get copies of your Excel spreadsheet? Yeah, I think we might be giving those out in the class. Let me find a way to do it through the class and do it through lab coats. Because guys, if I get 800 phone calls or even 50 phone calls or 50 emails saying, hey, can I have your spreadsheet? I'm going to spend too much time emailing spreadsheets out to hundreds of agents across the country. And to be frank, I unfortunately don't have time to email out one by one. I do have time to give it to lab coats and say, hey, here it is, something you can share. So let's go with that angle. I think too that we, I don't know how they're going to distribute it. They might even want to monetize it. I don't know. I'll talk to lab coats. I'll tell you what though, one thing in this network that we always look for is good agents. And I always say, hey, if you guys are looking for an agent to work with your clients that will work with these spreadsheets and will work with this mindset, let's do the introduction and have that relationship. I can help you in those ways. Unfortunately, I'm not going to be able to stay and listen. Yeah, it's all going to get posted. Visual learners. Yeah, and guys, I'm a visual learner too. That's why during this webinar, I don't like to just talk and have conversations. I like to break away and share my screen and show you PowerPoints and show you numbers and show you spreadsheets. It's the best way for me to teach as well. You have someone who's paying all cash. What conversation do we have with them? Sometimes I bought all cash too, just to make an offer more attractive. Nothing wrong with that. Your long-term return on investment will be higher if you use leverage, if you use a loan to buy versus if you use cash. A lot of people might say, hey, it's good to have property that you own free and clear. There's some good attributes to that, but you will not get the highest return on investment. And I will show you guys that on a future webinar. I've got a spreadsheet that I think we dove into 2 months ago, and we'll dive into it again. It's a very complex looking spreadsheet, but it shows you that using leverage will definitely get you a much higher return on investment than not using leverage. Great example. Let's say you got $500,000 and you can use that $500,000 to buy a property all cash for $500,000. You're going to cash flow right away off of that bad boy. And you're going to get cash flow in your pocket every single month because you bought it all cash. Or you can use that $500,000 as a 25% down payment on a $2 million property. You might not cash flow as much or if at all, because now you got this big $1.5 million mortgage payment above your head every month. But your rate of return is going to be much, much higher on that $2 million property with a $1.5 million loan than your rate of return on a $500,000 property that you bought all cash. Again, we'll dive into that during a future analysis with a completely different spreadsheet that goes a lot deeper. Webinars, informative. Okay. Can buy all cash and refinance. And that's another thing. Can buying all cash and if you go out and buy all cash and then you refinance out of it, does the interest count as a deduction? Okay. That is a great question. And that is a good reason that maybe you don't want to buy all cash. Because if you want to get your money out of it, can you write off the interest associated with the money you just pulled out? Grace, that's a good question. There's another one I'm going to say, talk to your CPA, but let me give you a little bit of an answer to it. So the IRS has a handful of different types of interests defined by various things, and you can only write off certain types of interest. So let's talk about a few. You have consumer interest, you have home acquisition interest, and you have investment interest. Those are your three main interests. One of the three is not tax deductible. Two of the three, in most but not all circumstances, is tax deductible. And you can probably guess which ones. Consumer interest is not tax deductible. So what is consumer interest? Credit card debt, car debt, pretty much debts you use to buy material goods, consumer interest. I have never had those debts in my life, and I would never carry those debts. Pay off your credit card every month, don't have a car payment. If you're a realtor, you shouldn't be driving around the newest, flashiest car unless you can afford it and buy it cash. I've never had a car payment in my life, never gonna have one. I drive a 2004 Ford pickup truck, okay? Because you don't want consumer debt. The other type of debts, you can have as much as you want of it. And I wouldn't get mad at you otherwise. And those are home acquisition debts, the debt you use to acquire a home or substantially improve a home. And as you saw, that debt can be written off up to $750,000. So let's say I buy a home all cash, and then a couple months later, a couple years later, I pull the cash out of it by putting financing on it. You can do that, and I've done that before. I bought a duplex all cash, and then right now, in fact, I'm pulling a bunch of that cash out through a refinance years later. If I use my proceeds to go have an awesome vacation in Vegas, or if I use my proceeds to go buy a new boat, I don't get to deduct that interest. If I use my proceeds to buy real estate and invest, now I do get to deduct that interest. So that goes back to that interest tracing. It really depends on what you do with the cash you pulled out of that property. I would not do a cash out refi and then go blow the money on a boat or a vacation. If I do a cash out refi, I would go reinvest the money, even if it's invested in a bond, the stock market, IRA. But that said, it gets really complicated at that point, and you need to be working with a good CPA. I've said that a dozen times, because if you use that cash out and you invest it in a bond or stock, probably still write it off. If you invest it in a municipal bond that has tax-free growth, you might not be able to write it off. It gets very complex at that point. Even I would go talk to a CPA before making those big moves. And then someone else saying, yes, absolutely, leverage results in a higher return on investment. Yep. But I always think of what could happen if the owner becomes ill and doesn't have anyone to step in. That's a good point. But that said, I wouldn't worry so much about the owner becoming ill, but the building becoming ill, because the owner's not paying the rent. The tenants are paying the rent. And when you go out and buy an investment property, of course, the tenants are paying that rent to give you the higher ROI. Now you might have meant, what about the owner who buys the house? Okay. What if what if both of them become ill and they can no longer pay $6,752 a month? Okay. That's a challenge, isn't it? Well, you want to look at the property and ask yourself, what could that rent for? This home that has a mortgage of $6,752 a month, we could rent it tomorrow for $6,000 a month. You might be thinking, who would rent it for $6,000 a month? Guys, they were renting a 2-bed apartment in a much lesser preferred area in San Diego, still a good area, for $3,000 a month. This home is a few blocks from the ocean with panoramic ocean views. This home would rent for $6,000, maybe even $6,500 a month. So their rent, if they got sick, they both got deathly sick, they could move out of this house, maybe move back in with family or something, and rent this house for darn near what the mortgage payment is. So Marguerite, I think you're the one who said, hey, what if someone gets sick? Maybe that's a good reason to have the mortgage paid off. As long as you can rent it for close to or approximately what the mortgage payment is, you're probably okay. And then the other thing, well, what if like one of them dies or something happens like that? Life insurance. The moment you start owning a home, the moment you start having kids, you should get life insurance. And you should have, everyone's need for life insurance is different. If you make $50,000 a year, your need of life insurance is different than someone who makes $500,000 a year. If you have a $100,000 mortgage, your need is different than someone who has $1 million mortgage. But Once you start becoming an adult, as I like to say, and having kids and having a real job and getting married and owning a house, you need to look at life insurance. A lot of people get term life insurance. So something to talk about with your children, your clients. My clients are my children. Something to talk about with your clients about that need to get life insurance. So with all that said, I know that we've only got 4 minutes left. And there's so much more I want to get into. You see the slides on the left I'm skipping to. That's something I wasn't even going to get into today. But next week, what I want to get into is the cap rate misconception. A lot of people think cap rate is your rate of return. I'm here to tell you your cap rate is not your rate of return. It is a portion of your rate of return. And the truth is, K is your real rate of return. What is K? We're going to get into that next week. Excuse me, when I drink coffee, it gets to my throat. But we're going to get to K next week, folks, and we're going to talk about the real rate of return. K is a financial constant that is used in all investment types: gold, silver, stocks, bonds, real estate companies. K is your rate of return. If you want to do a little reading ahead before next week, go into Google and type in something called the Gordon Growth Model. Gordon Growth Model, Gordon. And it was a professor out of Princeton or some school on the East Coast back in the early 1900s that came up with a financial formula to calculate the true return of any investment asset, real estate included. Now, K is cap rate is a portion of your return, but that Gordon Growth Model, the K, that is your real rate. Will it be the same day and time? Yes, folks, it's going to be the same day, same time, same bat hours, same bat location. Next Thursday, 9 a.m. And we're going to talk about appreciation. We're going to talk about cap rate. We're going to talk about your overall rate of return. And then we're going to talk about how they're taxed differently. Cap rate is taxed differently than appreciation. And I will tell you that those, a little read ahead here, those that invest for appreciation in the long term will become much, 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 much wealthier than those who invest for cash flow. Cash flow, though, is a sugar rush. Cash flow is an instant high. Cash flow is instant gratification. And that's why you hear cash flow all the time. Cash flow is like, it's like a catchphrase in our real estate industry. If you buy a book on investing, it's going to say cash flow 1,000,000 times and appreciation once. Yet the richest of the rich know that appreciation will make them much wealthier than cash flow any day because of the tax code, and we'll get into that, the current tax code, which can always change. The last question here someone's asking is, are my slides available somewhere, YouTube, etc.? Short answer is no. The long answer is they will become available. So I just hired a marketing manager, and we're looking at growing this educational platform in a way for me to grow really the educational side of my business. You all know I work in brokerage. I run a team of 12 agents, and we sell and buy real estate for clients here in San Diego. But I'm looking on branching off and creating another business side that is more the educational side. And when I bring all this out to you and the consumers and the realtors and everyone out there, I want it to come out nice and clean and polished. So I hired a marketing person to help me build a website and to start putting this information out there for all you guys. Right now, though, I know that it lives on the Lab Coat website that Jake so kindly put up for us. So you can check with Lab Coats for all these recordings. And with that, next week we'll have another fun class, and we'll dive into cap rate, the Gordon Growth Model, K, appreciation, and how taxes affect all that. But hopefully today you got some good knowledge that you can share with your clients from that spreadsheet, and you can show your clients that renting is so expensive and home ownership is how you can truly live for free and grow your net worth. Thank you all for joining today. And with that, I'll stop sharing and we'll sign off. We'll see you all next Thursday.